What's up, everybody? Thank you so much for tuning in and watching today. If you've never heard of the term Jubilee, it comes from the Bible. It's an ancient Jewish tradition back when Israel was being established in the Old Testament of the Bible. It was put into their law that they every 50 years as a nation, they would all debts would be forgiven. Basically, it was called the Year of Jubilee. There were some other things associated with that, like all slaves would be set free, land would be returned to the family owners. So there were some other things associated with it, but the main focus was the fact that all debt was to be forgiven. And so if you put your kind of put yourself into a society where every 50 years debt is going to be completely just wiped out and erased, well, what that's probably going to do is it's going to eliminate lenders from lending as you get close to the end of this cycle, right? Because if you know that in 1 year all debts are going to be they're just going to be wiped out, what incentive do you really have to loan, unless it's a family or a friend and you're just basically giving them money because they're in need. And so it was a way to kind of reset things and put the pause if there were any kind of big debt spirals, and if there were any kind of families or people that were trapped in vicious cycles of debt. It would allow them to get free from it. So there was this idea put forth by Porter Stansberry of Stansberry Research. He wrote a book called The American Jubilee. The book itself spends a significant amount of time discussing fundamental analysis and kind of some stock picks here and there. But the really interesting idea that he puts forth in this book is that the Jubilee kind of naturally happens every 50 years, or it has so far in America. And so in this video, I kind of want to go into that, look at the past, what has happened, and then look at why it looks like right now we are experiencing something like another debt jubilee that is beginning right now. Let's dive in. Okay, so just under 100 years ago, our country experienced the Great Depression. Now, something that we really have to make sure that we understand when we're looking at history and economic events is the difference in a society that has sound money system, something that with finite supply, it was backed by actual gold, versus a fiat money system that we have right now, where like as we're experiencing right now, the powers in charge have the ability to literally create an infinite amount of money out of thin air. They're entirely separate systems, and the laws, at least on the surface, the laws of money look very different in each of those systems. Now, when you have a system on a gold standard, over time you have deflation because you have a set amount of money in the system and you have goods and services getting cheaper, production technology. I've detailed this in past videos recently, but ultimately you have a system where things get cheaper over time because there's the same amount of money, but a growing supply of goods and services. You have real growth. You have things actually getting cheaper to make. And so every single dollar over time will eventually go further and further. So what does this specifically mean then for debt in a system like this? Well, it means that if I borrow money from you, let's say I borrow $100 from you, well, I'm still going to owe you $100, in a year. That the actual dollar amount, the number doesn't change. But if every single year the purchasing power of the dollar increases, well, then what that means is that my $100 that I owe you becomes more and more painful for me to pay back each year. $100 this year might be equivalent to 1 week's worth of groceries. But if I, in a year, 2 years, as the purchasing power of the dollar increases, then the amount, the actual purchasing power of that money goes up. And so what I owe you actually increases. It makes debt a lot more painful. In a year, 2 years, or 3 years, it might mean, 8 or 9 or 10 days or even 2 weeks worth of groceries in terms of its purchasing power. And in a system like that, over time, wages actually have to be decreased because things are getting so cheap that eventually you have to you're overpaying your workers if you just keep their salaries the same. Now, wages are usually a lagging something that lags behind other things in terms of when it moves in relation to inflation and deflation. And so in systems with deflation and sound money systems, a finite supply of money, the purchasing power of your wages tend to go up a lot over time. And we saw that all throughout American history until the creation of the Federal Reserve. Okay, so in a sound money system, debt gets harder to pay off over time. And so a sound money system punishes debt. Well, on the flip side, then it will incentivize savings, because every dollar you save becomes worth more and more. The purchasing power goes up as time goes on. And so on an individual level, from a business standpoint and at the national level, you have a system that, number one, incentivizes savings, and number two, punishes debt. So in a system like this, it pays really well to be a lender, because if somebody borrows money from me, if I lend money to you, well, I'm going to get paid back more than what I lend, because the purchasing power of my dollars in general are going to go up. In a system like that, I don't really even have to charge interest, because I know that when you pay me back, those dollars are going to be worth more. However, if there's a chance that there might be some inflation, because we've operated with banks on the fractional reserve banking system, so banks do have the ability to create credit, which is inflationary. It creates money out of thin air. So there's a chance, at least locally, that I'm going to lend you dollars, and in the meantime, before you pay me back, we'll have inflation. We'll have more dollars created that outpace the production of goods and services, which means that the dollars you pay back, I'll be able to purchase less than what I lent to you. And so the first thing as a lender that I'm going to do to compensate myself for that risk is charge you some interest. And so the interest will go up if there's a higher risk of inflation during that time. The second thing, though, that I'm going to do is I'm going to demand that if I choose, I can redeem my dollars from you, redeem my debt from you in gold rather than in dollars. Because if the money supply, the fiat money supply, the currency supply has gone up in that amount of time, well, we'll see inflation and the purchasing power of those dollars will be less. But that will not happen with the gold that's backing it up. And so in order to remove the risk of you giving me back dollars that are worth less than what I lent to you, in every single time I lend you money, I'm going to have a clause in there that says, if I demand at the end of this loan, you give me gold instead of dollars. Now, after the Great Depression started, when FDR came on the scene, he did two things in order to really end the gold standard, which began kind of the first debt jubilee that I'm talking about here. He legally mandated that gold clause be removed. He said, you're not allowed to demand gold in repayment of debt. The second thing he did was he devalued the dollar legally against the gold. Now, this meant that everybody who had debt outstanding, everybody who owed money, got off pretty much scot-free. That was a huge, basically a free money scheme to give to people who borrowed money, because now they got to pay back their debts with a lot less purchasing power than what they had originally borrowed. It punished the lenders. And so that was the first time we really had a debt jubilee in this country. There was a massive wiping out of debt in real terms, not in nominal terms, but in real terms, in terms of purchasing power. You had lenders that really got destroyed there. Now, fast forward again just a little bit under 50 years from there, and we come to 1971. We come to the late 60s when the United States had printed a lot more money than we actually had gold to back it up. Now, if you remember at this time, the world operated off of the Bretton Woods Agreement, which they came to after World War II, which basically meant all the world's currencies were pegged to the dollar, and they could redeem dollars for gold anytime they wanted. Well, the United States took advantage of this. They printed a lot more money than there was actually gold to back it up, and they used those dollars to purchase goods from other countries at really cheap prices, relatively. Now, when the rest of the world kind of started to catch on and realized what was happening, they realized, hey, there's a lot more dollars floating around than there's gold to back it up, so I need to get my hands on my gold. I need to exchange my currency for my gold before everybody else does, or else there's not going to be enough for me to get it later on. So essentially there was a run on gold where the world started redeeming all their dollars for gold as per the Bretton Woods Agreement. Well, we had taken so much advantage of this situation that there was nowhere near enough gold, and so at that pace of drainage, we had about 2 weeks left before all the gold was gone. And so Nixon shut the gold window, reneged on the Bretton Woods Agreement, and just said we're no longer redeeming dollars for gold. Subsequently, the money supply skyrocketed. Inflation went through the roof, and the price of everything just started climbing drastically and dramatically. Now, again, this was an inflationary period that resulted from the cutting off of the gold standard. There was no more any tether to anything finite. The U.S. government had the ability to print as much money as they wanted. And so this was highly inflationary. And if you remember from the beginning, when you have an inflationary environment, that punishes lenders, punishes savers, and it benefits the debtors, benefits the people who borrow money. If I borrowed money in 1965 and I didn't have to pay it back until 1979, I still had to pay back the same amount of dollars, but they were worth a lot less than they were when I originally borrowed them. 50 years after the first debt jubilee, we had another debt jubilee in the 70s where that rampant inflation basically wiped out the value of all of the debt. Now here we are, coincidentally, another just about 50 years since the closing of the gold window, the ending of the last ties to the gold standard. And we're here pretty much falling off the edge of a cliff, a financial crisis that has been triggered by a health crisis. And we are in an economy that was built on unprecedented amounts of debt. And that's from decades of extremely low, artificially low interest rates that have really punished savers and punished holding cash. And the only thing that you can do to move forward is to use debt to produce leverage. And what a lot of corporations did with that was just use that debt to buy back their stock. That's the best way to produce a return for their efforts due to the artificial environment created by the Fed. So they used all this debt, bought a bunch of stock, and that drove the stock market really high. That drove asset prices really high. Same thing has been happening in real estate. And so asset prices have been going up, and so we have a giant economy that's built, and all that growth, that fake growth, was built on this massive pile, this unprecedented massive pile of debt. And so the coronavirus has just turned into a catalyst for basically helping this giant economic insanity to start to implode. Well, what do you think is going to happen when you have all of this debt start to collapse? Because all of a sudden, nobody is getting any revenue. All these companies, one missed month of revenue makes them unprofitable for the entire year. So what are you going to do to all these companies who have so much debt that really they don't have sound business models? A good example, although this isn't a massive part of our economy, but a good example just to explain what I'm talking about here is the scooters that you find in cities where you download the app and you just hop on the scooter and it charges you for wherever you ride it. You just drop it off and leave it there and walk away. There's tons of those, and they're all funded by massive amounts of debt. Those are not profitable companies. They're all losing tons of money. They were just relying on using tons of debt to try and build up try and take over the share of the market, hoping that someday they would be able to raise their prices, become profitable, maybe pay off that debt, and they would have a large enough share of the market to be able to do so. Well, obviously that's not happening, and so all of these companies should go bankrupt. They didn't have profitable business models. They didn't have sound businesses. They were not viable companies. But what is the Federal Reserve doing? They are now buying all the debt. They've done more in the last month than they did during the entire first year of the financial crisis 10 years ago. They've opened up all the facilities, restarted all the programs to buy up debt literally as fast as possible. And it's not limited to treasuries. That is their number one concern, but it's not limited to treasuries. They're buying muni bonds, they're buying corporate bonds, they're buying junk bonds, they're even now buying ETFs that are broad-based bond funds. And the only way they're able to do this is because they have the legal authority to print an infinite amount of money. And so in an environment, a recession is usually the cure for the disease. We have a disease of bad investments. We have a ton of debt that is piling up these really unprofitable and unsound businesses. So we have a lot of malinvestment and misallocation of funds in our society. So those should fail. And when those go bankrupt, then if there are any assets left over, those assets then are bought by the sound companies that didn't go bankrupt, that didn't fail, the ones that were actually, knew what they were doing and were a little bit more conservative. And so new managers and new owners will take over the assets and our system will be stronger. But they're not letting that happen. They're printing an infinite amount of money to buy up all this debt. And we know, based off of the experience in 2018, that it will never go anywhere. It's going to stay on the Fed's balance sheet for infinity. They're never going to sell it, and they're never going to get rid of it. Not only that, they're buying it at inflated prices, because if you left it to the market, it would tank that debt. And we know that because all that debt started to crater as soon as this collapse started, as of after February 19th. But they're buying it at inflated prices so that the companies who have issued that debt don't get hurt. And so what should be a massive deflationary event to cure and kind of burn out the rot in the system is turning into an inflationary event where there's more money being created than there are actually goods and services to equal out with, because we have a massive drop in the amount of goods and services and in growth right now. And so the amount of money that is being printed to take the place of all the debt that is failing is going to be way more than what is necessary. And so we're experiencing the third Jubilee. 100 years ago we had one, then 50 years ago we had one, and now we're starting to see the beginning of the new debt Jubilee, where all of the debt is basically being forgiven. We're probably going to see it with student loans. $1.7 trillion in student loans. A massive percentage of it is defaulting on, and I can't imagine what the numbers are going to look like as the kind of the crisis unfolds over the next couple of weeks and couple of months. We have an auto loan crisis. We have $1.5 trillion in car loans that are at record amounts of default. And again, I can't even imagine what those numbers are going to look like moving forward here. When you combine student loans with auto loans and credit cards and mortgages, that's just on the individual side of the debt bubble that we have in America right now. And then you add that on top of all of the the city debt, the municipal bonds, plus the investment grade bonds, plus the junk bonds from the smaller, riskier companies. Then you add that onto the federal government debt that we have, and the fact that the Federal Reserve is printing money out of thin air to buy up all the debt. That's what all these programs are designed to do. It's so that they can buy up all this debt. We're experiencing a massive forgiveness of debt, a massive jubilee where all the debt is going to be wiped out. And the result of that, just like it was 50 years ago and 100 years ago, the result of that is always inflation and will be inflation. So I don't put too much weight in the 50-year theory that every 50 years something like this has to happen, but it is just an interesting anecdote to me that we are about 50 years out from the last time this happened, and we're on the precipice of experiencing this massive debt forgiveness, massive debt jubilee system-wide. And so the moral of the story is don't loan dollars that can be created out of thin air. Don't be a lender with fiat currency. Even with the Federal Reserve buying up all this debt, we're likely to see a lot of bankruptcies coming soon, a lot of failures, a lot of collapses, as this financial crisis is probably impossible to contain at this point. Oh, thank you so much for watching. I really appreciate it. I do have a question for you guys. I'm considering in the next couple of days, as more and more of this information comes out and is kind of unfolds, especially with the bill set to pass. I think the Senate is planning on passing the new stimulus bill either tonight or tomorrow. I'm thinking about doing a live stream Q&A session. So if you'd be interested in having me do a live stream Q&A session, let me know in the comments below, and then I'll choose a day and time to do that soon here. So let me know if you think that would be something that you'd enjoy. And thanks so much for tuning in. You guys have a great day.